Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Today is Monday, August 11th, 2025. The S&P kind of drifting within its recent range. It's a quiet Monday before it could be a more active Tuesday. Tomorrow we get the CPI number, and that could be a significant catalyst overall. So I want to kind of just go through some of the things that are forming. We do see some cracks forming in the bull narrative. It does not necessarily mean that the market wants to um, move any specific way, right, in any one moment or any one, instantly, but there are some things forming. So here are the standardized returns of some ETFs that we're going to be talking about. I also wanted to tell you guys about something called Titan X. TradeStation is preparing to launch Titan X, the next generation of our trading platform. It isn't just a new model of our award-winning software, but a fresh trading paradigm that puts you in the cockpit like never before. If you're new to TradeStation, you can join the waitlist at tradestation.com/TitanX. You'll see the link in the description below, and it will be available to customers as a beta soon. I'm also going to share a few links quickly in the chat. Okay, these are the standardized returns you're seeing now. And then we're going to jump over and do some other stuff. Go to tradestation.com, scroll down the homepage, and you'll see our article. Apple's big week drove the Nasdaq to records. And I think that was a good way to look overall at what has been happening. A lot of the things we're going to be talking about are in this article. You want to check that out. So I think that it's kind of a very isolated and narrow sort of rally we saw last week. And, people say that a lot. And I'm not really so obsessed with things like breadth and stuff. It's not always a hugely important thing. But there were some things about it I think we should just kind of realize and see. So here's the overall article. I'm going to jump at some of the charts to actually show you here first. Is a chart of the S&P from that article. This is with Friday's close. So this price range is what we were kind of highlighting in that article. So let me just say, kind of a few things I look overall about the Apple news. I mean, it was really a one-off event. I think that's one thing we have to realize is that, this holding on Apple, AI, tariffs. I mean, this was this huge, kind of issue hanging over Apple for a long time. And then we had a resolution to it. So this is not maybe a lasting, ongoing catalyst. This was kind of a one-off relief sort of thing. So I think we have to realize that. Very often traders will sell unexpectedly bullish or buy unexpectedly bearish news. When you have this news as this kind of stunner in one direction or the other that deviates from the overall trend, that is often faded. So I think we have to realize there is some risk of that happening, here with Apple. So one of the things in this article, if you actually look at our article here, is I'm not going to try and dig into it, but it actually said that one of the things in there is that of the market's 8 companies with market caps of at least $1 trillion, Microsoft last week was the only one that was negative. So it does show that we're kind of focused on a narrow range of winners. However, at the same time, last week, I'm going to just quickly mention a few of these, is some of these companies had incredible sell-offs, though. If you look at companies like Gartner, this is an IT-related information company, but also Eli Lilly got really hammered. One of its biggest drops in a long time. VRTX, decent sized pharma company, got hit really hard. And this follows weakness we had seen before in companies like Eastman Chemical, Baxter, and Align. So these were like epic historic drops in these names, like biggest declines in a decade plus. So there's been a lot of really dramatic drops at the individual company level. I want to point that out because it does kind of show that this is kind of a narrowing sort of thing. When we look outside of the Mag 7, the really big companies here, we do see some kind of issues. And I think it puts us in a spot where kind of my main focus now is that we could be in an area where the small caps, some of these more non-Mag 7 things are teetering. And it could actually turn into something that if we get a CPI report tomorrow that is, hot or anything like that, or it's higher than expect or shows higher inflation, or if, just regardless, we could actually now be setting up a spot where the non-Mag 7 delivers some kind of performance to the downside. And I think we're looking here at the Russell, you can kind of see it's been teetering here. You see it's kind of rounding out. And I just want to point that out because as I look at anything that seems like the most kind of immediate kind of potential opportunity, given the run we've seen in other stuff, it might be more in that direction. So look here, you can see the S&P 500. This range this was the 31st of July and the 1st of August. It created this range that we're basically in today. Today we were kind of teasing around the top of the range, going up around like, I don't know, at 64.05 or I don't know, something like that. But we did not break above it. What's also interesting is that we have a daily closing high that we have not yet closed above. So let me just show some of these things here. So first of all, this range. Main thing I want to show the following MACD. Again, MACD itself not hugely important, but you just see a lot of things together. The main thing to me is this is a big dramatic sort of 2-day move, and it is forming a range, and we are still stuck inside of it. Now, this is another chart I just made today of the S&P 500 with some different breadth metrics. We can basically see that our advanced decline line has been trending lower since late July. I think July 25th was its high. The number of stocks making new 52-week highs has been trending lower. The stocks above the 50-day moving average has been trending lower. So this is our breadth workspace, MT breadth, from our market trends webinar we do on Thursdays that we've shared with you guys many times. Again, internals, not hugely important, but again, they show certain things happening. Now, to me, the internal I find more interesting, kind of my own personal measure of strength that I actually find most useful is this one. This shows the relative strength of the S&P against the XLP, the consumer staple ETF. And what we're actually seeing here is we're seeing that we're starting to actually now go flat. This is a 21-day trailing performance. Change it to a 10-day, which is the 2-week change. This is the relative strength of the S&P against consumer staples. And you can see here that we're actually negative now. In the last 2 weeks, we're trailing slightly. The S&P is trailing XLP. Now, it's interesting if you look overall, go back now. I'm going to make this back to the 21-day, which is the one I mainly use. You can see here, look at the other times when the market was ready to drop. Look in January, you see the relative strength against the consumer staples starts falling before the market does. You can see at several points in time. I mean, this one, it kind of, I mean, it doesn't always work exactly, but I think the key thing is you can really see it weakening here before the market started crashing. And there are other times like this. You can see it right here, as the market was pulling back. So it's just one of these things to be aware of, that when actually look back here, in June of 2023, same sort of thing. The relative strength here really kind of stalled. It's just interesting. The main thing I want to point out here is that this is something that is not always the most conclusive thing, but you will often see market tops preceded by relative strength lagging versus the small caps versus the consumer staples. When consumer staples start to outperform, it can be a kind of warning sign that starts. That's one of the things I want to mention. Now, another thing I thought was interesting, very quickly, I'm just going to look at I'm going to remove this now, but look at the banks here. To me, this is something that I wanted. This is the regional bank ETF. I mean, I'm just looking at this because this is something also that's kind of small cap related. It's cyclical related here. And, this might be viewed as like a bear flag. And so I think right now, this is something else to be aware of. And this is also, there are some signs here at the economy weakening that are starting to show some potential weakness. Now, another thing to remember about Apple is if you actually look, there's a growing evidence now that Apple might actually face boycotts in India because of some of the political things that have been happening. So again, there might be other things that, kind of turn around and suddenly become not great news for some of these companies. So I want to just kind of point out that there are some other things out there that have not yet asserted themselves. These are factors that are kind of hitting the market that have not yet really followed through and not yet actually manifested themselves in the S&P going down, but you can see a lot of these forces building. And very often what can happen is these forces build, the price doesn't show it, and then all of a sudden the price shows it. And I think we have to realize now is that we're in a spot where the potential for that is potentially greater than it was, back here when we were still rallying higher. So now we do have some potential warning signs. So for example, this close right here on the 28th of July at 63.90, just under 63.90, was essentially the all-time closing high. We got close to it on Friday, but we closed just below it. Today we ticked above it, closed below it. So that's a daily closing high. We also have on this chart the megaphone pattern we showed at the time, this big widening outside day and a huge outside day, this megaphone pattern that we're back up right kind of in the middle of. So it's interesting. We're back at that level that was the beginning of the megaphone, you could say. So, I mean, again, patterns like this have varying degrees of importance, but when you see a lot of them all kind of pointing in the same direction, it just kind of gives you something. So again, I'm not trying to point an overly bearish picture because the market has been continued to trend higher. But I think we just have to realize is that we're entering a period of weaker seasonality. And what I think the bigger takeaway could be is that if the market does start to break down, we do have the kind of groundwork now laid for a more lasting period of weakness. And it might not be really sharp right away. It could be something that kind of does last for a while. So my point would just be buying the first dip in a kind of drop of this kind of nature might actually be a kind of it might actually not have a fast rebound. It might actually need to play out more over time. We might need to get that spot when we actually get to the Fed meeting or something like that. I want to just kind of point that out. Now, another thing that's been very interesting to me is aside from names like Palantir, look at stocks like Trade Desk and stocks like Fortinet. There's a lot of technology stocks. Look today at Monday.com getting really hammered. So there are a lot of technology stocks here that have not been doing well. Look at Intuit; it was doing well, but again, so this is all showing the kind of this is good earnings and everything. But again, the multiples on these are very high, and I thought it was interesting overall as well. If I wait, let me get to that in a second. Let me also show some of the things first. This is the credit spreads. Shows junk bond credit spreads, and if you actually look, we've been trending higher here since January. So it is interesting to see here. This is actually starting to show a greater sense of economic weakness. This is like you can actually see back in January we got to the lowest level in a long time. I used to be a credit guy. I haven't looked at it as much recently, but this basically shows that companies at this point they were back to levels from 2006 here. So basically, this showed that there was very little default risk, and companies were able to borrow cheaply. Now we're making a higher low on the junk bond spreads. That is also something here that does show a sign of economic, kind of canary in the coal mine. Junk bonds are canary in the coal mine, a potential warning of some weakening in the economy. There's an article on CNBC last week that said private equity firms are struggling to sell assets and take their companies public. There's been various articles about a glut of condos and apartments. And those things, again, go back to those regional banks. If you have unsold, condos, if you have things like apartments going unrented, that trickles through to commercial real estate. Don't forget what happened back with Silicon Valley Bank, that when the long end of the curve went higher, there are exposures in commercial real estate. We have built a lot of multifamilies in this country in the last 10 to 15 years. And there are signs of that market not doing terrific. And so, again, it doesn't mean that we have the banks like, another bank run or something. It can just mean that banks are heavy and they face a big headwind until some of those bad loans wash out. And it could result in maybe more loan loss provisions and more heaviness in that chunk of the market. So I want to, kind of mention that. If you look at the recent data from the Institute for Supply Management, we saw the services data was weak last week. Last week, we also saw initial jobless claims miss estimates for the first time in almost 2 months, and we see continuing claims. They keep going higher. The productivity and unit labor costs last week for the second quarter were kind of stagflationary. They were higher than expected. So, there's there's an argument that can be made against the Fed cutting rates, even if jobs are kind of struggling, because of the fact that the productivity numbers haven't been there, and there have been some other potential concerns with again with tariffs. I mean the CPI tomorrow will say a lot, but the huge $64,000 question is, do we get a tariff hit trickling through to CPI tomorrow? If we do, it could kind of create a new sentiment that might not be as positive. And a lot of the this is now the weekly, the S&P, a lot of the strength that brought us off these lows here could turn into a period of anxiety. So I want to just point out on the weekly here just quickly that we actually do see here this level down towards 6,200. That might be in the event of a bad sort of number, that might be the spot where people kind of look to see an initial sort of move, and then after that we'll have to see what kind of goes from there. We'll have the PPI, and then on Friday we get retail sales, and so that will kind of shape things from there. But in the near term, I'm looking down toward this level, around 6,200 here to see, in the event of something bearish. Now, if something bullish happens, this could extend to the upside. I think here we have to realize we're at a spot where technically, we see certain things happening, but this is now, I think, an area where the the economic data is going to potentially become more important as we move away from the thick of earnings season and as we move toward the CPI data and as we move toward Jackson Hole on the 22nd, and then we move toward the September Fed meeting. Historically, that's kind of the way things play out. So we're moving away from the positive AI fundamental period, and we're moving towards something that has the potential to be less of a positive sort of news environment. I'll also mention when you look at those big job revisions that everyone's been talking about that came out for the month of July, is that very often when a recession or an expansion happens, one of the measures of that is that things beat or miss in a big direction because people are not yet ready. So when something starts moving, it moves more than you expect. And so if those revisions just potentially, I'm not saying this, but those actually could actually be the mark of a serious degradation of the job market. And in 6 to 12 months, people might look back and say that actually maybe marked the beginning of something that could potentially be even a recession. So I think we just have to realize is that when something moves quickly and you get that kind of quick deviation from the expectation, it often can show that something deeper is happening under the surface. So I think we have to realize that. And then when we look out also, we can see some of the things that I thought were kind of interesting as I look out as some potential risks that might be coming. There's been increasing anecdotal evidence of job cuts in the healthcare market, healthcare industry, and that is something I think we have to realize that has been a backbone of this job market. But there is some potential that's starting to happen. The student loan repayment thing that affects a lot of people. I think 4 million people are I think 4 million people are behind on some of those student loans, and that can result in all kinds of other issues for consumer spending and things like that. And then there's a lot of news coming through about AI resulting in job losses. So we could see kind of a trifecta of negative things hitting the aggregate demand of the economy and the job economy all kind of at the same time. And I think we have to realize those things could all be kind of happening as we speak, and they will only be clear 6 months from now as the economists put together the final numbers. Before I get into the big index, I want to just mention a few other companies that for some reason stood out to me that I thought were kind of interesting. One of them is Union Pacific. I mean, here we have a railroad stock. Transports are kind of one of these bellwethers. And I mean, this one just looks to me how it just can't get above the 200-day. I mean, this is something that people might look back and say, wow, this is a long-term sort of topping pattern in this stock that's gone nowhere for like 2 years. No, 4 years. And I'm just saying, there's not a stock many people trade, but it's maybe telling us about the economy. UPS, also FedEx, economically sensitive names. Now, another stock that doesn't get a lot of attention, but I always thought it was interesting is Kirby. They operate tugboats for like barges and stuff. Again, economically sensitive. When you see a barge getting hauled around full of like gravel or something, they do that kind of thing, operating the tugboats that pull the barges. Again, you kind of see here, they had good earnings, no guidance, the stock got hammered. So this is starting to maybe show here some weakness in the real cyclical part of the economy. So I think we have to realize that AI has been a phenomenal driver of a lot of things, but if we start to get to a point when we really do see the potential of a recession, even the AI sort of thing will become something that people start to say, you know what, that isn't going to keep going into a recession. There's going to be companies that are spending big on AI. Those plans could get cut back, or investors would just say, I don't want to be paying high multiples as we enter a period of economic weakness. So I think we have to realize here is that these other things, there's a reason why transports are considered a leading sort of indicator. Another one that was interesting to me, I want to just point out, and I'm not sure why this is happening, but look at a stock like Datadog. It had good earnings, and here it is, just stuck at the 200-day. And I think this is, to me, I'm looking at some of these names. You have the big 2021, top, this huge, peak in tech stocks. And then here's a company that's had good earnings, and here it is making a lower high than back in the end of last year. And what I'm kind of seeing here is that these companies have high multiples overall, and there just seems to me a real lack of buying power in these. And when things just kind of sit at the 200 and just kind of crumble under them, I've seen that kind of before, and it's kind of what you see when people are starting to see more of a kind of recessionary environment here. So, it is concentrated in a small number of companies. There's a lot of companies out there that are showing kind of strange things. And this is why we're seeing the advanced decline line not doing well. It's why we're seeing things like the fewer stocks making 52-week highs. So I want to just kind of point that out. Now we turn to the big indexes as we mostly focus in this webinar. And here I want to point out, we do this big outside week. I'm going to remove that because it no longer has as much relevance. I think overall we are in an area here where, this, to me, the level that stands out is, there is a little bit that we could point to down here at this level, which was basically the close here of 6297, which was a weekly close that we can potentially kind of look at. It was a weekly close from kind of mid-July, and then we bounced out the following week. We bounced we held near the bottom of it last week. I am at this point. I think when you look at how low the VIX is and the tightness of the range and the seasonality, my first area I'm looking to here is farther down here. But people might see a little bit up here. It's kind of 6297, 6300. But from my view here, that 6200 was important, especially because we had back in mid-July, we had double tests down here to 6201. So I'm kind of looking for this gray zone on this chart, kind of between 61, kind of 70 down up to 6200 as the kind of first zone that I'm kind of looking at here. If we jump back over to the daily chart in this here really quick, SPX on the daily, I'm going to move the 200-day, go back over here. Sorry. We showed that we had this record closing high, and just the fact that we're just kind of remaining inside of this range. I think this range people might want to just put on their chart and really mark it out for a while. I'm going to kind of drag it over so we can kind of see it, and it'll be there for us when we come back. Okay, let's go to the Qs. Qs are very similar here. Now, from my perspective, these have the most relative strength, and in some ways, like these may have the least kind of downside potential. So people looking for, a sell-off, if you're looking for a sell-off, and the thing that may rebound most quickly from that, from a bad number, and I would say almost here that people might actually want to be, this zone down here, almost up. I would now raise this level up to the low of this week here, because we basically had that test. It was basically the week begun July 14th. That low was around 551 and a half. That level, I think, now is kind of where people might want to be kind of looking to see. But overall, I think we're in a spot here where this has the strongest weekly chart. And, this is something where if we get bad news, it could have a drop that is quickly bought. And that might be what people looking for the bullish momentum will be looking for. But however, it could maybe say it drops down here, it could rebound and make a lower high and then just kind of go into a period of pausing and consolidation. I want to just point that out. The seasonality going into September is not as favorable. So that is another thing just to think about. Now, the Dow here is also in a spot that is kind of more troubled. And I think that this now has gotten kind of stuck below 4,500, and it's kind of trying to hold on here at this high from back in October. So this might actually be more in a spot here where people look, if they're worried about a downside here, might actually look for the Dow to take a move down to 42,000. And I think that we do have some weekly levels across here. 42,100 is kind of the level that shows up here. But I think we're in a spot here where we have this kind of failure and this kind of quick drop. So the other thing I'll point out is if you look at the S&P here, we had kind of talked about a level. It was basically a 50% retracement of the sell-off of this 2-day move. And we basically had said, wait a second, what's going on here? We basically had said that, let's kill that. We had basically said that if we got, something is wrong with my drawing tool. I don't know what's going on with this. We basically said that if we got to, if we stayed above 63.20, it would draw potentially to the up. This is not drawing right for me. Anyway, we said if we got above 63.20, we said, I don't know what's wrong with. I apologize. We said that we got above 63.20. That would potentially have some follow through, and that was that level right here. We talked about it last week. We got above 63.20, bounced at it, and we did extend to the upside. So I want to point out that was an interesting sort of, thing that we noticed, and it did work. However, at this point, that may have played out. So I want to just kind of emphasize that. And now if we look over at the Dow, it's kind of interesting to look at the Dow because we actually can see on the Dow that we did not actually managed to do a 50% hold a 50% retracement. Let's see if my Fibonacci works again on this. I don't know what's going on with this. I don't know. There's something wrong with my drawing tool. Anyway, this one I don't think got above it. If you look at this move here, it didn't reclaim nearly as much of the drop. So you can see the drop, and then it basically does not retrace as much of it. And my key point here in all of this is that the Dow is not showing the same kind of strength. It has not broken out above its level from November. That is, I think, the key thing about the Dow. This is, more of a values focused thing, more of a cyclical thing. And I think we have to realize here, like I said, the non-Mag 7 parts of the market, for the most part, are showing some real strain. And that, I think, is being reflected in the Dow. It's also interesting here to look at the DJT, not the Trump stock, but the Dow Jones Transports. And this also, we were talking about this, but this has also had a very sharp drop and very little bounce here. And so from my view here, this is also kind of showing us overall weakness in the cyclical parts of the economy. And this might be an interesting thing to watch, the Dow Jones Transports, to see where it kind of puts us. Now, the Russell here is also potentially in a spot where people looking for downside, might actually be kind of focused on this. It's interesting if you look at the level we had from the week before, the low, essentially. You can even actually go back to this weekly close here. But the level I'm kind of interested is the weekly low from the week begun July 21st. What you essentially see is this old support. We're stuck under it, and this could really turn into some resistance here. So, if we do have more recessionary vibe and things like that happening, something like the small caps could really be the place where the sellers show up. And it's interesting to look at this big level from back in January. We kind of highlighted this. We highlighted this some time ago, and look how it just became resistance. So I think here we're starting to see some downside risk developing in the Russell, and this might be the way to play things if you're feeling more negative. If you're looking more for the downside, this is something where I think the Russell is giving us that potential opportunity, and we kind of see that with things like the small caps we had talked about. There's also some bad news, potentially bad news today in the biotechs. If you look at the regulatory thing with this gentleman who was considered to be I can't remember exactly what his role was, and there was something when he left it was considered a positive, and now when he's apparently coming back, which is considered a negative. He's some guy in the FDA, but I want to just kind of point that out. You can look into it yourself. Now, the 10-year Treasury yield, I think, remains a highly important thing here, and I remain in a spot where this is, to me, remains a serious concern, because the fact is, last week we had bad auctions for the 10-year and the 30-year Treasuries, and if we do start to see some higher inflation, the supply of debt that the U.S. government is going to start issuing and is starting to issue is really significant. And again, people have ignored it, and people have said, "Oh, it doesn't matter," and that might be true. But the fact is that there is a lot of supply coming to the market, and we're seeing essentially this thing hold 4.25. So I think right here, 4.2. So this is the 10-year Treasury yield, and I think essentially here we have to really see what happens, because from my view, despite whatever the economy might be doing, there is risk of this on the longer term sort of moving higher. The auctions last week were not good, and I think that is just something to think about, that if there's a sense that the Fed is going to be less committed to fighting inflation going forward, the market will push the long end of the curve higher, regardless of what the short end does. And you can have, the yield curve is actually relatively flat by long-term historical. So you could easily, you could see the Fed cut 50 and the long end go up 50. That can happen. So right now with Treasury yields, this is something that despite the kind of weak economic data, it is showing here some sense that there might be a reluctance of people to lock in money for this kind of duration, and it could actually be suggesting here that the long end of the curve actually does have upward pressure regardless. So this remains to be something I continue to watch. Now, the dollar index here is kind of stuck under this level. So from my perspective here, one thing that could happen is if we do get soft inflationary data, this could very well get slammed to the downside, and we could see a real rush of money into things like global stocks and gold. So I think we have to realize is that if the data tomorrow is soft, the real takeaway might be weak dollar trades. So I think that's something to point out. If the data tomorrow is more high inflation and people are worried about the Fed being hawkish, then this could very well be something that people look for it to kind of remain in this zone and kind of stab back up in this area. It might not have a lot of upside, But I want to just point out that if the numbers tomorrow are relatively, dovish, the real takeaway might not be long S&P. The real takeaway might be long silver, long gold miners, long global stocks. That might be the way the market reacts. So I think we still want to kind of bear that in mind at this moment. Yeah, I don't have that much time left. I'll quickly go through some of these here. Um, I'm not even sure to make of things like the materials here. From my view, this is, again, same sort of thing where it's just sitting in this range. And I think with the economic data, kind of concerning here, this is now in a very tough spot. It's a weird illiquid sort of thing that I'm not too sure about. Communications here also, very tight overall, nothing bearish. But it's something like this, the opportunity might be a bad number that drives it down to 105.5, and then that becomes a potential entry. Energy, on the other hand, we've talked about this, and this also might be starting a real kind of breakdown. And I think XLE here, when we look at this with a, kind of recessionary and, potentially economic slowdown and OPEC cranking out lots of crude oil, this might be something here where we do see this opportunity for a drop. The one thing, though, is if there's an inflationary number, what we might get is we might get some failed rallies in XLE. We might see XLE rally up toward kind of 86, and then we might see opportunities to go the other way. But this here is potentially looking very heavy. We talked about this range it was trying to hold, and last week on our webinar on market trends, we talked about the potential of it breaking through 85, and people might think it's starting to crumble through that level there. Very quickly, I will look also at the financials, and I do think your financials are at a spot where this might be something where if things are not terrific news tomorrow, people might try and drive financials lower here. So I think we need to realize is that this might actually be an opportunity for financials to go under 50. This might actually be people looking for a move back to the June lows in the XLF. Industrials also have done very well despite having what people are talking about as a weakening economy. And if we do start to get that, this could also be something where people actually look for, some more weakness in this. So I think we have to realize, move toward under 147 in the XLI, is kind of a potential thing that could happen here if we get numbers that make people think that the Fed is going to be, hawkish. Say if we got high inflation number, people can say, well, now the Fed's not going to cut. And if that's the case, something like industrials might not do very well in that environment. XLK here is very similar to the Qs. It's a part of the market that, has that strong sort of tailwind right now. People might just look for any kind of drop kind of down toward 259, 260, in the near term. But this does have some interesting support down here at 257. And, from my view, that's something that it might require something pretty significant and down and bearish to get under to really get much below that. XLP here does kind of show this overall strength, and we had kind of cautioned about this as being a kind of for the bearish side, that this could actually be a concern about the economy. Again, here, this is something where I think that, given this environment here, we might actually see consumer staples XLP push up toward 84.5, 85. Given the overall backdrop we're seeing, it could do that and then just peter out. It's not much of a trading vehicle. Real estate investment trust, XLRE. This to me also now is showing a false breakout. And I think I'm just seeing more evidence of struggling issues with commercial real estate and apartments and things like that. This could become a problem. And if the long end of the curve, it moves higher or stays higher, these guys face refinancing risk. And that's just something that it remains an issue. Utilities here had this kind of breakout, and from my perspective now, people might be looking, if anything, for a retest back toward 84.5. That might be more the kind of area here that, that 84.5 stands out to me as the first level to look at on here. Healthcare, we had talked about the longer term bearishness developing, and this actually now may be at risk. From my perspective here, it's in a range. So people might need to see a real close. I'd say at this point, a real weekly close under even under 128 to really have a confirmation of this being bearish. The market, from my view, this remains in a challenge environment, but there could be tests back up over to 132, 133 in the XLV. But this is showing us a pretty significant weekly sort of failure with this consolidation essentially below this level. I don't normally get into head and shoulders very much, but this is something that seems to be kind of manifesting that pattern. The XLY, we had talked about the potential in this, the potential for Tesla to have a move to the upside, which did happen We talked about Tesla breaking out of this triangle. It's kind of trying to do that, but now we're also in a spot where we're back to essentially this falling resistance line. And this might be something here where this is potentially going to just follow what the overall market does. So those are the main things I want to talk about. Remember, we will be back on Friday. I'm sorry, on Thursday for market trends, and that will actually be the last market trend we do until after Labor Day. So please join us for that. Hope everyone has a great day, and I'll see you Thursday.